When we talk about credit risk, we're really talking about one simple question. What could go wrong when we lend money? But the answer isn't just about whether someone defaults. Credit risk is actually a combination of different risks that together determine how much a lender might lose. At its core, credit risk includes default risk, recovery risk, and exposure risk, along with other factors like migration risk, spread risk, and liquidity risk, and it often moves together with broader financial risks such as interest rates, exchange rates, and inflation. So, to fully understand credit risk, we need to think about both the probability that something goes wrong and the size of the loss if it does. Let's start with default risk, which is the most intuitive one. Default risk is simply the risk that a borrower fails to make promised payments, either missing interest or not repaying principal. To measure this, we use something called probability of default, or PD. This can be estimated using historical data by observing how often similar borrowers have defaulted in the past, or by using statistical and mathematical models that analyze large portfolios of loans. Sometimes institutions combine quantitative models with expert judgment to refine results, and in market-based approaches, they even extract default probabilities from bond prices or credit spreads. Default risk is typically measured over a one-year horizon, but even very short-term lending carries some chance of unexpected default, so the risk is never truly zero. But default alone doesn't tell us the whole story, because even when a borrower defaults, lenders often recover part of the money. That's where recovery risk comes in. Recovery risk is the possibility that the amount recovered after default is less than what was owed. The recovery rate tells us the percentage we get back, and the complement of that is called loss given default, or LGD. Recovery depends on many practical factors, like whether the loan is secured or unsecured, the quality of collateral, the legal system and bankruptcy process, the seniority of the lender's claim, and overall economic conditions. For example, during downturns, asset values may fall sharply, reducing recoveries. Estimating recovery is challenging because defaults are infrequent and data is limited, so institutions often rely on simpler top-down models rather than very complex ones. Finally, even if we know the probability of default and how much we might lose after default, we still need to know how much money is actually exposed at that moment. That's exposure risk, measured as exposure at default, or EAD. For simple term loans, exposure is usually just the outstanding balance. But for credit lines or revolving facilities, it's more complicated because borrowers may draw additional funds right before default. To estimate this, we calculate exposure as the amount already drawn plus a portion of the unused limit, adjusted by something called the loan equivalent factor. And beyond loans, other items like receivables, guarantees, and contractual obligations can also increase exposure. Because borrower behavior is uncertain, banks often use stochastic or behavioral models to forecast future exposure levels.